First, breathe, because the fastest way to get wiped out is to hear a weekend headline, feel your stomach drop, and then convince yourself Monday is locked. Nothing is locked, but something is happening, and it's in your sources. The Reuters-linked coverage that LiveMint is relaying is clear on the regime. U.S. and Israeli strikes on Iran, retaliation risk, and investors running to safe havens. Gold above $5,200 on the day, and the market bracing for a Monday open that could be violent. So before we go any further, one word only in the comments. Gap if you think Monday opens higher and holds the premium. Fade if you think Monday spikes, and then the premium bleeds out once the market gets dispassionate. Gap or fade. No edits after the retest. We grade it. Quick guardrail so we stay in the adult lane. I'm not selling signals, mentorships, or memberships. I'm not claiming motive. Different feeds print differently. This is educational, mechanics, not hype. Now here's the whole video in one sentence so you stay locked. First candle is chaos. Retest is the verdict. And Monday's verdict is whether the war premium sticks or bleeds out after the first spike. Now I'm going to extract the clean material from your two sources, and then I'm going to stitch it into an OG-style high-retention read. Important note, I tried to open the Reuters link directly, but it returned an internal error in this environment. So I'm using Reuters material as quoted inside the LiveMint live blog, and I'll only repeat what LiveMint attributes to Reuters. Here's what LiveMint says. Clean, factual, source-tied, gold and silver soared amid Middle East tensions as traders bought safe haven assets and gold rose above $5,200 an ounce. LiveMint says negotiations between Washington and Tehran will continue next week, with Oman describing significant progress, but also notes U.S. officials remain disappointed, so the diplomatic picture is mixed, which is exactly why the tape stays stressed. LiveMint says experts believe the tensions could push silver prices above $100, but they don't call it locked. They frame it as conditional, and they give you a level map. They quote Tim Waterer of KCM Trade via Reuters, saying gold is likely to be in higher demand than usual at Monday's open because of duration risk, spillover risk, and inflation fears, and gold becomes the safe haven asset of choice. They quote Edward Meir of Merex via Reuters, saying we'll likely see a knee-jerk spike in commodities, including gold and oil, as a natural response to the outbreak of hostilities. They quote Fawad Razakzada via Reuters, saying extra haven demand could lift gold back to around $5,500 and possibly above January's peak, around $5,600. They add an important plumbing detail. Physical gold flows through Dubai could be curtailed for a couple of days because airlines cancel flights due to heightened tensions. Dubai is a major supplier to Switzerland, Hong Kong, and India. Then the key silver near-term map. LiveMint quotes a SEBI-registered market expert, Anuj Gupta, saying COMEX silver closed above $93, faces a barrier at $95, and could reach $100 if it breaks through and stays above $95. That right there is the spine, not $100 locked. It's $95 is the barrier. $100 is the magnet if $95 is accepted. Now we build the OG-style read around that because the entire internet is about to do the exact wrong thing Monday morning. Half the people will scream $100 guaranteed on the first green candle. The other half will scream it's a trap on the first pullback. Both reactions are emotional. Both reactions get punished. So here's the only rule that matters in event regimes. Don't trade the headline candle. Trade the verdict. I'm going to give you two tells. You'll hear these words again and again because they're the only things that keep people alive in stress markets. Tell number one, acceptance after the pullback. Tell number two, does stress normalize? Tell number one is simple. On the 1 hour chart, yes, 1 hour, because it filters some of the noise. You identify the breakout hour at the open, then you mark the decision band, the body close of that breakout hour, and the midpoint of the impulse move. That band is the decision zone. Rule: I only respect continuation if we get 2 hourly body closes holding the decision zone after the first pullback. 1 wick is noise, 1 spike is noise, 2 closes is acceptance. Tell number one. Tell number two is the lie detector. The market can gap up and still be a trap. How do you know? You watch whether stress turns off quickly or not. In a normal market, after the first burst, things calm down fast. Spreads tighten, wicks shrink, execution cleans up, tape smooths out, and physical loosens on red candles. In a stressed market, after the first burst, stress stays on. Spreads stay wide longer, wicks stay long, tape stays bursty, execution feels messy, and physical does not loosen quickly. That's tell number two. Now, I'm going to connect those tells directly back to your sources, so this isn't my opinion. LiveMint is effectively describing both scenarios. Edward Meir's knee-jerk spike line is the phase one behavior. First candle is emotion. Tim Waterer's higher demand than usual line supports the idea that the war premium could stick if duration and spillover fears persist. And the Dubai flow disruption is an example of why premium can persist longer than people think, because in war regimes, logistics and insurance and transport constraints matter. Now, the most important part of the live mint silver map is the barrier logic. $95 is the barrier. $100 becomes plausible only if $95 is broken and held. That is the most defensible, most powerful way to frame your title without getting roasted in the comments. So I'm going to do it. Your title says $100 Monday gap up locked in. That is not what the sources say. What the sources support is war risk plus haven demand plus $95 barrier on potential for $100 if acceptance prints. That's the adult lane. Now, since you want maximum retention, we're going to do the two audience module because it keeps both camps watching. If you're a long-term stacker, Monday's first candle doesn't change your thesis. It changes your environment. War risk increases the probability of sustained safe haven demand. Live Mint explicitly describes safe haven flows and a multi-year gold rally narrative tied to geopolitics, trade tensions, and dollar debasement concerns. But you still don't chase a candle. You watch whether the premium sticks. If you're a short-term trader, Monday is dangerous because war tape opens are where slippage and fakeouts live. And if you're over-leveraged, even being right about the long-term story won't save you. You can be right and still get liquidated. So traders need one rule: trade the verdict, not the headline. Now let's walk through the two scenarios, clean and binary. Scenario 1, gap, then fade. This is the knee-jerk spike path that then cools once the market refocuses. Gold gaps up, silver gaps up, everyone celebrates. Then the market becomes dispassionate. It checks the real pivot: duration risk, spillover risk, and crucially energy route disruption risk, because that's what keeps inflation fear alive. Live Mint repeatedly flags oil route disruption risk as a key variable. In this scenario, you see long top wicks, you see spreads tighten, you see the tape smooth. Most important, you do not get acceptance above the decision zone after the pullback, and silver rejects around the barrier area. LiveMint's own map puts the barrier at 95s, so $100 remains a headline, not a magnet. Scenario 2, gap then hold. This is the pressure scenario. Gold gaps up and holds because the market decides duration, spillover, inflation risk is real. Tim Waterer explicitly frames those risks for Monday. Silver hits the barrier around $95, and instead of rejecting, it builds acceptance. That means 2 hourly body closes after pullback that hold the decision band. In this scenario, spreads stay wider longer, tape remains bursty, execution remains edgy, and physical does not loosen quickly. Dubai flow disruption is the kind of detail that tells you logistics constraints can keep tightness alive even when paper wants to normalize. That's when $100 becomes a magnet, not because it's locked, but because the market is acting like the premium is sticking. Now I'm going to give you the clean Monday plan section in a way that's not advice but is operational. You watch 3 windows. Window 1, the first hour. Is it vertical with long wicks and messy spreads, or is it controlled and holding? Window 2, the first pullback. Does price reclaim and hold the decision zone, or does it fail and bleed out? Window 3, the barrier. Does silver behave like $95 is a ceiling, or does it behave like $95 is a floor after acceptance? Because once a barrier flips from ceiling to floor, magnet levels become reachable. That's how markets work, not by prophecy, by behavior. Now I want to address one detail in the Live Mint blog that most people will ignore, but it matters. They mention negotiations continuing next week, significant progress, and U.S. disappointment at the same time. That means the tape is going to be headline-driven. And headline-driven tapes don't respect comfort zones. They whip, they gap, they punish certainty. So if you're asking, is $100 Monday guaranteed? You're already thinking like the person the market is designed to punish. Instead, you ask, does the market accept above $95 after pullback? Now, let's incorporate the MCX side because LiveMint includes it and your audience cares. LiveMint lists MCX Gold April futures closed at Rs1 to 62,104 per 10 gray, and MCX Silver May futures settled at Rs2 82,644 per kilo, up 5.48% on Feb 27. That means India reopens into the same event regime. And LiveMint notes physical gold rates in Indian cities are expected to surge even while MCX or COMEX are closed Sunday. So Monday isn't just a COMEX story, it's a global reprice story. Now here's the part that keeps retention high and feels like a reveal. The real war premium is not the green candle. It's what refuses to normalize after the pullback, because anybody can spike a market. The question is, does it stay bid when the first burst is over? That's why I keep repeating the rule. First candle is chaos. Retest is the verdict. Now, quick risk management reality, because this is your credibility signature and it keeps you out of trouble. War tapes create violent whipsaws. If you trade with leverage, you can get wiped out even if your thesis is correct. If you're stacking physical and thinking long-term, volatility is the cost of admission. Know your camp. Know your time frame. Now, I'm going to close this with 3 takeaways, and I'll tie every one of them to the sources so there's no trust me, bro. Takeaway 1, Live Mint, via Reuters quotes, frames Monday as a safe haven open with a likely knee-jerk spike in gold and oil and higher than usual demand for gold depending on duration, spillover inflation risk. Takeaway 2, Live Mint's silver map is clear. COMEX silver closed above $93, faces a barrier at $95, and $100 becomes plausible only if $95 is broken and held. That's the adult lane version of your title. Takeaway 3, war regimes aren't just price, they're plumbing. Live Mint reports physical gold flows through Dubai may be curbed for a couple of days due to flight cancellations, which is a real-world example of why premiums and dislocations can persist longer than a normal weekend would imply. So, Monday comes down to this: gap or fade? And the market will answer with 2 tells. Acceptance after pullback, stress normalization, does it shut off or stay on? Drop your word now. Then come back after the pullback and reply to your own comment with what printed. Accountability over hype.